Welcome to my 10 lessons I've learned from investing in small cap stocks. Lesson number 5, cash is king. Now, I mentioned in a previous episode that some of the best performing stocks are small caps, micro cap stocks. In fact, they're below 20 million market cap, below 10 million market cap. And most of these are pre-revenue. That means they have no revenue. Or if they do, they're probably loss making. So where do they get their cash from? It's always worth asking this question. And the simple answer is they issue new shares. Normally the discount is called an equity fundraise, or more commonly known as a placing. And this is the thing that people get scared of, and you should be. As an investor, you do not want to be investing directly before a placing happens. Why? Because placings are done at a discount to market value, market prices. So, for example, if a company needs cash, they'll go to their broker and say, we need to raise some cash, and the broker will contact investors on their, so their clients there and say, okay, this company is raising cash, and the market price is, say, 10 pence, they're raising cash for 7.5 pence. And so, and I've seen discounts up to 50%. I mean, so you do not want to be investing in a company before that happens. So, you have to work out if a company needs cash or not. And discounts vary, and it depends on different things. Depends on the broker, depends on the company, how desperate they are. Depends how demanded the share price is. Depends if there's some big institutional investors want a chunk of it, or it's all private investors, who are looking to flip the stock straight away for a quick buck. But it creates downward pressure. So a good time to invest is after an equity fundraise, not before. So we're going to try and find out whether a company needs cash or not. How do you do this? Right. Every 6 months, a company listed, a PLC, has to release an interim report and a full year report, financial statements, basically. So the first 6 months of the financial year is called an interim, and then at the end, it's called a full year report. And they have to release this by law, and included within these has to be an income statement, a financial position or balance sheet, and a cash flow statement. You have to look at all three of these and learn about them. Really do. Just look at stuff on YouTube, learn them. I'll go through into one in a bit now, the three of them now, on the basics of it all. But you have to go into that. By the way, if a company is dual listed on the TSX in Toronto, Canada, or on the ASX in Australia, they have quarterlies as well, so that have financial statements come out even more regular. So that's worth checking out, because there they have to state their financial position as well. But we're going to look into a financial statement and or results by a company, and we're going to try and figure out how much cash they have. Because it's not easy, it's not straightforward, because when they release their interim results, that can be 3 months after the end of the reporting period. So, for example, if they release in December, they don't have to release until January, February, March the 30th. They don't have to release until. So already it's 3 months out of date. And with a full year result, it can be 6 months after the close of period. So you have to work out the cash burn since then and when they've raised any cash, okay? But you do that by looking at the income statement, the balance statement of the financial position, and the cash flow statement. And we'll do that right now. Okay, so here we are on feedbacks page on Vox Markets. By the way, try Vox. It's free of charge. The app will send you live, fast RNSs straight to the front screen of your phone, whichever company you follow. But we're on feedback. FDBK is a company I hold, and I want to figure out how much cash they've got. Okay, so go to the news tab, and this shows all the RNSs, or regulatory news service announcements from the London Stock Exchange, which are official announcements they have to release because they're significant in the way of price, share price. So scroll down. I'm looking for the most current financial report. So it's either an interim or full year report. Full year is 12 months, of course. Interim is 6 months. So, okay, feedback, GE Healthcare, Textile Goods, nice contract. Scrolling down, general meeting, revised strategy. Okay, 2-year contract with Royal Papworth Hospital, nice. Okay, what is it? Oh, hang on, look, equity fundraise. So that's interesting, because they've raised money there. So we need to keep that in mind, because that's what we're talking about. They've raised money via equity placing. Okay, so keep that in mind, because that's come after the results, obviously. So they've raised money since the results. So let's scroll up. And did you see half year results there? There it is, half year report, 26th of February. That was out, and that was for the 6 months ended the 30th of November. So it's 3 months after the period end, and so already when they came out, they're 3 months out of date. So that's why we have to calculate how much cash they've got going forward based on how much they've lost in the previous. Like I said, it's only a guess, That's all we can go on. Unless you know of another reason why they've been burning less or more cash or earning more money, then we'll just take it as a normal sort of average. So at the top of any statement, you've got the highlights here, and they will have financial highlights. Sometimes it depends how much detail they put in there, but they have shown us the revenue there, and the loss, and the cash. But it's always worth going down to the income statement, balance sheet, and cash flow statement. Always check it out. You've got to. Here we go. Here's the income statement. So revenue was 229, cost of sales 6, very low, gross profit 223, other operating expenses 575. So operating loss was 352, loss before tax, and they got a tax credit there. So the loss attributable to the company was £348,000. So we know that's 348 was the loss, 348 over 6 months. That's how much they lost. Now, go to the balance statement or the statement of financial position. That shows you the assets broken down into non-current and current. Current are sort of liquid assets of 12 months or less that they have access to, and liabilities pretty much also non-current are anything they have to pay back within 12 months or more. Current liabilities are 12 months or less, like other payables will have to be paid back within 12 months or less. So we're looking for, under current assets, cash and equivalents. That's 267. All right, so even after that loss, at the 30th of November, they had £267,000. I want to know, though, what their operating loss was, okay? So we got that from the thing, and this is what it is. So loss before tax at 348 is the operating loss. That's how much they lost in the 6 months. So thinking, okay, so how do I work out now with 3 months down the line since these results? How do I work out how much cash they've got? So this is the way I do it. It's only a guess. I get a monthly figure. All right. So what I do is get a calculator out. 348,000 they lost in 6 months up to 30th of November. I'll divide that by 6 and get 58 grand. They're losing a month. All right, based on the last 6 months. Obviously, they may be burning less or more, earning less or more cash. So it's just a guesstimate. But always be conservative if you can. If you read through the statements and the results, you may see that they may have overspent for some reason. One initial, payment for something or other, or it may be just run of the mill cost expenses. So anyway, I'm using 58 grand. I'm going to say 60 grand. 60 grand a month they're burning. That's what I'm going to say. Okay. Now they had how much cash left was it? Up to I think. In fact, it's on the cash flow statement as well. Go to the bottom of the cash flow. Cash and equivalent at the end of the period. So 267. All right, 267. So I'm going to say, okay, let's say I got 267,000 cash at the 30th of November. Divide that by 60 grand. That will last them 4.5 months. I'm going to say 4 months. I'm always going to be hyper conservative. So we go 30th of November, 30th of December, 30th of January, 30th of February, 30th of March. They had cash up to the 30th of March. It's now almost September. Okay? But, hang on, they raised money, didn't they? So they got cash up to the 30th of March, but they raised money. We saw that in the last RNS. Let's go back to the RNS a second. So RNS, 440,000. That's always gross. When they show the figure they've raised, it's gross. And so they will say here before expenses, normally around 5% charge. So what's that? 10% is 44 grand, 22 grand off that. So let's say 420 grand they had. 420 grand. So we'll get the calculator again. They had 420 grand in March. So put that in there. 420 divided by 60 again, assuming they're burning 60 grand a month. That's 7 months. So let's go April, 30th of April, 30th of May, 30th of June, 30th of July, 30th of August, 30th of September. They're very close. So now, while I'm recording this, we are start of September. They need to raise cash unless their receipts, their revenue's gone up and their cash burns come down. But on a conservative basis, they're close to raising cash. And do you know what? I'd wait. If you're looking to invest like the company, I'd wait. Because if people know that they need cash, and it looks like they do, the share price is coming down. And the share price is coming down. I'll just show you a quick chart. Let me just show you a quick chart of, in fact, let's go up to here. So the charts on Vox. So on chart, you get a nice little chart here. Look at that. So go to a year chart. And it's gone up to 3.5 pence. And it's down at 2 pence here. So it's down to 1.68 there. So let me just see the price here. So 1.8 they're down to at the moment. So down here. So they do need cash. And people think they need cash. So you've got to wait. Because one of the best times to invest in a company is after a fundraise. Why? Because they've got cash and they can carry on for the 6 months without needing to raise, 6 to 12 months maybe, and generating value from the business, hopefully. Plus, you'll get the share price at a lower level because people realize they need cash. Some people will be flipping. Some investors in the company who took part in the placing will be flipping for a quick profit because trying to take advantage of that discount. So you get some downward pressure. So you get a good price and you know full well the company has cash. I hope that makes sense. Cash is king. Never forget it. Never jump into a stock without knowing how much cash it's got. A business cannot survive without cash. Think, cash is king. I will be doing a series actually on my research strategy, what I use. It's an acronym called CASH, spelled in a slightly different way. But I'll go through that. I hope that hopefully that will help you on what to look for, on how to research a company. All right, but if you like this, please comment if you have any questions whatsoever. And by all means, subscribe. You'll see my face now. See it? That's it. Click on my face, hit the subscribe button, and you'll get my next video straight to your inbox. Thanks very much.